FedEx, ticker symbol FDX, is currently trading at $197.89 a share. It is doing very well, up almost $20 on the year to date, which is just 11.63%, doing very well. You can even see it's beating companies like Amazon in 2023. Now, is this the right time to buy? That is the question I'm going to be answering today. We're going to be looking at my stock valuation spreadsheet, which uses discounted free cash flow model, the Ben Graham formula for valuing stocks, and the comparable companies model to see if FedEx is a buy or a sell. So as I said before, yes, in 2023 it is up 11%, but if we take this over the last year, it is down 8%, beating once again companies like Amazon and Tesla, which is very good to see. But if we look at the stock over the last 5 years, at the bottom of the pandemic, it was around about $106 a share and is up 85% since then, and that includes it dropping down from $300 a share. So this stock has been all over the place. Is this the right time to buy? So let's go to my stock valuation summary spreadsheet. We type in the ticker FDX, and currently has a market cap of 50 billion, a dividend of 2.21%, which is around about $4.37 a share. Very, very nice. And if you want the dividend, buy before the 23rd of June. So we have a look at the steps here, and firstly we want to see the P ratio. Is it less than the market average? Market average is around about 21, and FedEx is shy of 16, so that's excellent. Straight away a pass. Next is the revenue increasing. Yes, it is 70 billion to 93 billion, and you can see revenue has steadily increased apart from 1 year, which was the pandemic year, where it only dropped a little bit. So this company revenue is still growing very, very strongly. Now, profit. Is the company profitable? Yes, it is. Is it increasing? Yes. $500 million in the 4 years prior, 3.8 currently. Now, yes, it is increasing. That's excellent, but you can see it's down from the prior year, 5.2 billion. But overall, it is increasing upwards. Next, you want to see if they're issuing more shares or buying back their shares, and FedEx are actually issuing more shares. Now, not many, only 6 million over this time. Why do we care about that? Well, if there's 10 shares of a company, you own 1 share, you own 10% of the company. If they then issue 10 more shares, there's now 20, you would then own 5% of the company, 5% of the profits. But what can they do with these shares? Well, if they're issuing shares back in 2019, they were issuing them at 250, even 170. So this was bad. The stock then shot up. They were issuing shares at this price. That was when the stock was at its highest. So overall, I would say it's probably been a good thing because the stock has had that massive run up in 2021-22. Hopefully they use this money to invest in the company for growth, things like that. Then it could be a good decision. And finally, we're looking at free cash flow. Is free cash flow increasing? Yes, 123 million to 3.069 billion. So 4 passes, 1 failure. Overall looking pretty good. Free cash flow ratio, which is market cap divided by free cash flow, is about 16.27, which is good as well. And the dividends paid, well, they pay about $1 billion in dividends. This is a very safe dividend, 36% of the free cash flow ratio, and that is with a dropping in the prior year. So let's get on to my discounted free cash flow analysis. This calculates the future free cash flows of FedEx and discounts them to today's value to give a value of the stock based on what we know now, plus estimates. Let's see what it gives us. And well, surprisingly, it's a $60 stock according to this. Now, if we look at these numbers, these estimates are way lower than what we had in 2022. And we'll see why if we look at the top here, probably due to the pandemic year. Net income margins, pretty much all over the place, quite low in 19 and 20. So let's bring it back to about 4.08. We'll use the current year. Revenue growth rate, well, we can see it was about 17 and 10%, flat growth in 23 and about 5% in 2024. So we'll keep that number the same, but you can see the pandemic year really did affect it. And finally, free cash flow and net income, 2020 minus 60%. So what we'll do is we'll take an average of these 3 years, which is about 61%, and we'll see what that gives us. So you can see the free cash flow has already increased. That puts it at $145 stock. Now, I do think that the 80% is a fairer number, and that gives us about the free cash flow of what it is in 22. $194 stock. So assuming that they are going to have some growth over the next 5 years, which analysts, well, we'll talk about that in a sec, they are expecting growth. Let's just say they were able to grow 10% a year. That would put it at a $202 stock. So discounted free cash flow said the stock is about fairly valued, but with a bit more growth, obviously, it can increase. These numbers are still far from their 2021. So if they were able to grow with their earnings, which is coming out quite soon, you'll be able to see that the values, see what the value is here. Next, we look at the Ben Graham formula. This is the father of value investing, Ben Graham. What this does is it looks at earnings per share versus growth of a non-growth company times by the corporate bond over the average corporate bond, which is 4.4, times by the corporate bond at the minute. So if we look at what the analysts are expecting the company to grow by, we scroll down here, 4.08% over the next 5 years, which is pretty similar to what they grew over the last 5 years. Well, what does this give a valuation of the stock? $180 a share, which means it is overvalued at the minute, and a Graham price of 140, which is a margin of safety. So both models are saying the stock is either fairly valued or overvalued at the minute. So now let's look at my final one, the comparables model. This is looking at metrics of similar companies and then coming up with different ratios and then calculating the implied value per share off these ratios. These ratios are enterprise value to revenue, EV to EBITDA, and PE. Now, when I looked at comparable companies, there's only really one in the US, and that is the United States Postal Service. That is another one, but obviously we don't have the financials for that. So it's the United Parcel Service, otherwise known as UPS. Now UPS is a lot bigger, in terms of equity value compared, market value compared to FedEx, but I think this is the most we can look at here. So if we look at the values, EV to revenue, what we want to see ideally lower numbers here, and EV to revenue is 0.7 compared to 1.7 here. So the lower means they're more undervalued. So in terms of EV to revenue, it's undervalued compared to UPS. EV to EBITDA, that is earnings before interest, taxes, depreciation, and amortization. And once again, the ratios here are 7 and 9.2. Lower is better, and PE ratio 15.5 to 14. So we will calculate using the averages of these, and this will give us values of around about $400 a share for EV to revenue. That is a massive number. Gives the enterprise value of FedEx at around about 111 billion, which is a lot higher than what it would be, which is why it's $300 a share. Then the EV to EBITDA, 237 and 223. So basically, if the ratios can get in line, well, it's basically saying that if things were valued as the same way as UPS was, then the stock would be about double. So even though the discount free cash flow model and the Graham's model don't like it as much, if we compare it to its direct competitor UPS, based on the revenues, you can see the revenues are about the same, but the net income is a lot higher on UPS. But if we were to take off these same ratios and look at the stock price, the implied value per share is a lot higher. Right guys, thanks for watching. Please give a like on the video if you enjoyed it, and I'll catch you guys next time.